started. Okay. Oh, by the way, is there anyone that does not have this, did not get this in the email? It also is included in the assignments. We'll have them available also. So if you didn't get it, if you don't get the email, you can also get it from the Blackboard. Okay. Let's get ahead and get started. Okay, independent auditors report. Now, this is very important. We have to be independent of the company. So we're doing this is for ABC company. We have to be independent of ABC company. So, for instance, if you have your company and your brother is a CPA, can you have your brother do your audit report? Nope. You have to be independent. So it's an independent audit report so that people can trust it. They can it gives credibility to the financial statements. Okay, it starts out with the opinion. The first paragraph is what we did. We audited the balance sheet, income statement, equity or retained earnings, and cash flows. Those are the 4 statements that we do. And in our opinion, the accompanying financial statements present fairly in all material respects. We'll talk about this more. Results for operations. Operations is like income, the income statement. And cash. Oh, financial position. This is the balance sheet. You say, why don't they say balance sheet? I don't know. But the financial position is the balance sheet. So this is the opinion. This is everything in auditing is to go to this to get an opinion, for this to be the opinion. Now, here's another weird thing about auditing. This audit report that I'm showing you, most of we tell you don't plagiarize things. Don't plagiarize, don't plagiarize. If you're an auditor, you are required to plagiarize. You have to use this report. You cannot make up your own report. It has to be like this. You can lose your license if you don't follow using this report. This is a report put out by the ACCT330, and every state requires that you use it. So if you're wondering, you say, well, don't different CPA firms have different reports? No, they don't. They're required to use the ACCT330 report. So this is a standard report that everybody must use. This is what they call a clean opinion. This is when everything is okay. But this is an opinion that we have, in our opinion. And you'll notice something about this that might strike you as a little bit odd. And that is, we say that they present fairly in all material respects. Notice what we don't say. We never say that these are accurate. We never say they're correct. We never say, we don't give assurance right down to the penny. No, we say, look, they're presented fairly in all material respects, the financial position, operations, and so on and so forth. So this will tell you that there's some judgment involved. Okay. Basis for our opinion. And you generally have the standards for the country that of the rules you're using. It could be international standards. In the United States, they usually use the US standards. You could use international standards in the United States. And in that case, you'd say, international standards. Okay, let's go to the responsibilities. management is responsible for the preparation of the financial statements. So the auditors are not responsible for the financial statements. Management is. Management makes the financial statements. They're responsible for the financial statements. And here's another thing, the auditors cannot change the financial statements. Now, if we find an error, we'll tell management, hey, by the way, you misstated this. And management will have to change the financial statements. The auditors do not change the financial statements. Only management can change the financial statements. Part of that is being independent. If we change the financial statements, we're no longer independent. Now it's our work, not the client's work. And by the way, client, when we say client, that means whoever we're auditing. So if we're auditing IBM's financial statements, IBM is our client. And again, we don't change the financial statements, the client does. Now, if we do find something wrong, we tell them, and hopefully they will make the changes that we suggest. But we are not responsible for the financial statements. The client is. So whoever made the financial statement is required to. They're responsible for them. Okay. They talk about the accounting principles they use. Usually it's going to be so this will be what we call GAAP, generally accepted accounting principles. These will be accounting principles, GAAP. That's what the we're saying whose GAAP they use. It could be international. It could be U.S. GAAP. Okay, so the question becomes, okay, so the manager is responsible for the financial statements. What are the auditors responsible for? Okay, we are responsible to give an opinion. So we are going to look at the financial statement and give an opinion on it. Now, here's where it gets really different than what we're usually used to in accounting. We give reasonable assurance, but it is not absolute assurance. So notice this. We are only looking for those things that are where we're giving reasonable assurance about it, and not absolute assurance. You might say, well, what does that mean? Well, you can give a fairly high level of assurance financial statements. It would be impossible. Let's take something like Walmart. It would be absolutely impossible to get 100% accurate financial statements from Walmart. An employee walking out on December 31st might stick a candy bar in their pocket, and the financial statements won't reflect it. In a perfect world, they would. But now, when we come to things that are material, well, let's go back to this. So we give reasonable assurance that they are free of material misstatement. Let's do this again here. Reasonable assurance, the same thing as I have on here. Of material misstatements. And again, we're only looking for misstatements that are material. So reasonable assurance about whether the financial statements are taken as a whole are free of material misstatement. All right, so let's go back to Walmart. Let's say that you find a $5 million fraud by auditing Walmart. Is that material? I don't know what Walmart's income was, something like 10 billion or something. But let's say it's 10 billion, and you find a $5 million fraud. Is it material?
Yes.
It would get your attention, but it's probably not material. I mean, certainly if it's a fraud, you certainly tell them about it. By the way, this person is stealing $5 million. But as far as the financial statements, it probably wouldn't make any difference. It's probably less than 1% of their income. It may not change the financial statements at all. The way they round off the financial statements, they may round it off to um, yeah, exactly. In terms of market cap, no, there's no way. There's no way $5 million is going to make a difference to them. And so now $5 million to a small company might be the whole company almost. So it really depends on the size of the company. And sometimes you'll see, someone say, well, the auditors were here every year, and this person was stealing $50,000 a year. It's like, well, they're not looking for someone stealing $50,000 a year from Walmart. And by the way, to find that kind of an error, it probably costs more than $50,000 even to try to find it. So you only look for things that matter, things that are big enough that it's going to change it. And it is kind of funny though, and everyone goes through this, I think, when they go into auditing. I audited for Navistar and for US Steel. And you run into these situations, especially when I was working with the external auditors, that I remember finding $100,000 error. And, $100,000, right out of school. Hey, look at this, look what I found. And I remember giving it to the external auditors, and they're like, all right, whatever. They didn't care. They honestly didn't care, but it does kind of, go against what we normally think about in accounting. When you find something that that's wrong, you want it fixed, or whatever. And external auditing is way different. You run into a $5 million error. If you were auditing Walmart, you talk to your the senior auditor, and they would probably say, don't put it on, write it up, but don't write it up as being material. You can put it, obviously documented, but and if they want to fix it, they can. But even if they don't fix it, we're not going to do much with it. Okay. Yeah, I think I read somewhere Microsoft is the market cap on it is like $3 trillion now or something crazy. All right, it's amazing how big these companies are. Okay. Now we look for we look for misstatements that are either caused by, it could be caused by a mistake, an error, or it could be caused by fraud. And by the way, back in the day when I was going through, we just said misstatements. We didn't care whether it was fraud or error. And we go on to explain why. If something is materially misstated, it's likely that it could be fraud. And why is fraud harder to detect? They kind of go through a little bit of it here. Why is fraud different than like a mistake? So let's say I have a material misstatement I make that I have a stapler for $6 and I ring it, I put it in the system for 6 million. Okay, I made a mistake. I don't know, I wasn't paying attention, and I put it in, instead of $6, I put it in for 6 million. That's probably going to get caught because it's going to hit somebody's budget, and someone's going to say, whoa, where'd the 6 million come from? They look it back up and they find it's a stapler, and they go, oh, this is wrong. It should be $6, not 6 million. So oftentimes, if it's a mistake, it gets caught. But if it's fraud, it may not. Why? What's different about fraud? If someone is intentionally doing it. So instead of me making mistakes, 6 million, they say, okay, you know what? We need to hit our numbers this next quarter. So why don't we're going to put on $6 million and see if you can spread it out among a couple of the customers, you
I
know.
think the frauds are more sophisticated, better thought of. So, in order for them to hit the facts, financial in their financial statements, they want it to seem logical. I don't know if I'm wording this right, but this is my understanding. Like they're trying to conceal the information so it looks good, like it looks reliable or like logical, but it's not. So it's the fraud is more sophisticated error, I would say.
Yeah, that's exactly it. You get people who are actively trying to cover it up. And the people who are trying to cover it up, two things. First of all, a lot of times those people came out of auditing. You know, we're not talking about just somebody off the street that walks in and says, "Oh, let's just do it." You're talking about people who know what you're going to be looking for. So they know what how you're going to test it, what you're going to do. They know where you're going with it. Now, if you do, you can still find it sometimes, and you should be able to. But they'll know what you're doing, and they're actively doing it. They're actively trying to deceive you. They're not. It isn't like, oh, gee, how'd that get in there? They're actively trying to cover it up. And remember, as an auditor, you might go in and do an audit. Maybe it takes 2 or 3 weeks. Well, you got people that are there all year round. They have all year to figure out how to keep it from you. So it is you're up against smart people, and smart people try to whatever they're trying to do. It takes some effort to catch that, much more than say an error that usually it'll hit somebody's budget. Budgeting is a good way to find errors because everyone's responsible for a certain budget, and if something hits it, they start asking questions. But yeah, so people are actively looking for it. So then that's why they go through here. It may involve collusion, forgery. They may forge some documents to make it look like that this is a sale or whatever. If someone returns something, you don't pick it up. You put it in a warehouse somewhere. There's all kinds of things. Override of internal controls is also a big one. Almost all fraud has some type of override of controls. So we tell everybody that. Now, one of the things that we talk about is professional judgment. And that's actually a very loaded statement. It doesn't look like it is, but we exercise professional judgment and maintain skepticism throughout the audit. You'll notice something here. So professional judgment. So professional, that we're professionals in what we're doing, but also this judgment. All of auditing is judgment. All of it. What's material? Even for Walmart, what's material? Okay, 5 million doesn't. How about 50 million? How about 500 million? How about, at some point it does become material. What is that point? That's a judgment call. And even when we do testing, we'll say, okay, well, we're going to do statistical testing, and this will tell us that we're 95% sure that it's within this range. Okay, and you can quantify that. Okay, well, there's still judgment there. Why are you using 95% as your the level of that you're using for assurance there? Why aren't you using 90 or 99 or something in between? Those are all judgments. Even statistically, those are judgments. So everything in auditing is a judgment. And that's another strange thing about where we're as accountants, we're used to, okay, here's the rules, this is what goes into it, and this is how you do it. Whereas auditing is judgment. And by the way, this is one reason why auditing can be difficult to learn, and because it is judgment. Learning judgment is difficult. Okay. And until we design our test to try to catch those things, blah, blah, blah. This is a little bit jumping ahead of ourselves, but internal controls. For a normal audit that is not a publicly traded company, we look at internal controls, but we do not express an opinion on those. And we just come out and say, we're not expressing an opinion on the internal controls. And by the way, that is another thing about the audit of the financial statements. We're auditing the financial statements. We're not auditing, their bookkeeping. We're not auditing, their necessarily their systems they have for management and things like that. We're looking at the financial statements. The financial statements are what we're writing our opinion about. So anything that goes into those, into those financial statements, as long as the financial statements are, we're reasonably assured that they are free of material misstatement, they get a clean audit. And, whether their systems are a mess, management or accounting systems or whatever, logistical systems, whatever, we report on the financial statements. So that's what we look at are the financial statements, not all the other things that go along with it. Okay. And let's, we can probably go on here a little bit. This is a new thing, so I'm going to talk about it a little bit. And one of the reasons I talk about new things is new things are far more likely to be tested on the CPA exam than old things. And key audit matters are fairly new within the last 5 years or so. So a lot of times it'll be in there. And that is when you have something that's significant that you think people reading the financial statement should know. So they're not necessarily bad. They're things that there could be assumptions or whatever that were made. They could also be something like, oh, by the way, did you notice that, this company, it sells 78% of its stuff gets sold to Ford. It's got one customer that is taking 78% of their production. Just know this because, well, if Ford goes bankrupt, they probably won't. But if Ford goes bankrupt, you may have a problem. Or if Ford just says, well, you know what, we're going to go somewhere else, they just lost 78% of their sales. So it could be things like that. You're not saying the financial statements are misstated, but you're saying, by the way, look at this. This might be important. Okay, so let's go through this. And I just realized I didn't cover something here. I gotta cover one more thing. I gotta go all the way back. This is my walk of shame back to the very first. And this is who we send this audit report to. Who is it for? Oops. Hold on. What happened here? I don't know. Yeah. Okay. This is very common to have it sent to the shareholders and the board of directors. Notice it is not sent to management. Why? Because management makes the financial statements. They already make them. They should already know what goes on in the financial statements. So we send it to people on the outside. This is sort of like giving some comfort to people on the outside that they can rely on the financial statements. People on the inside should already know. Management should already know what's going on in the company. It's people on the outside we got to tell. We looked at these financial statements and they're okay or they're not okay. But that's what we're doing with them. Okay, so let's. Why I skipped that, but all right, we'll do the true false and we'll take a break after this. The audit report is addressed to the company's management. I just talked about that. You can put it in chat if you want.
False.
False. Management should already know. Is it addressed to the company's shareholders?
True.
True. Yep, people on the outside need to know where they can learn on the. So if you own stock in IBM, you want me to know if you can trust these financial statements. Just because you're an owner doesn't mean you're inside IBM. Okay, the financial statements are the auditor's responsibility.
False.
The audit report gives an opinion on the company's financial statements.
That is true. True.
True. The audit report gives an opinion on the company's accounting system.
False.
False. The audit report references accounting principles used to prepare the financial statements.
True.
True. Yeah, that's that gap, either US gap or international. US or international standards are the two most common. It could be other things though. If it's not publicly traded, you could have them do cash basis or something like that too. The audit report references auditing standards. The auditor use the auditing standards.
True.
Yep. Yeah, they could be US standards or international standards. Usually the standards go along with what principles they use. So if the financial statements are international standards, usually not always, but usually if the accounting standards are international, then the auditing standards are international. It doesn't have to be that way, but the audit report provides an assurance that the financial statements are correct.
That is false.
False. We never say correct or accurate or anything like that. The audit report provides absolute assurance the financial statements can be relied upon.
True. False.
False. And the key there is the absolute.
Absolute assurance. There's
Right.
no absolute assurance.
Exactly. We give reasonable assurance. And not to hit too fine of a point on it, but for instance, taking inventory, let's say Walmart, it would be absolutely impossible to do 100% inventory for Walmart. There's not enough auditors in the world that you could have come in on December 31st, or I think their year is probably in January. But there's not enough auditors in the world that could come in and do that. It'd be impossible to do 100%. So say that we do it, absolute assurance is impossible. Okay, let's stop here. We'll come back and let's take like 10-minute break. What time is it? 6:59. Let's say be back at 7:09. So we'll take a break, come back at 7:09, and we'll see how far we get with this. Okay. Okay. Dude, what the heck? All right. Let's see. Wait, give me 1 second. Okay. So chapter 1. Okay. So basic audit steps, depending how you break these down, but you got to get a client. Obviously, this is going to be someone you're going to do their books or auditing. And getting a client is not as easy as it might seem, because you have to be independent. And not only do you have to be independent, but you also have to be able to complete the audit and that you trust the client. You don't just take any client. And that's another thing that's different about accounting or auditing than other things, is that you pick and choose who your customers are. It's not like McDonald's where anyone that walks in can, get a hamburger and whatever. It's not like that. It's you have to pick the client. It has to be someone that you're independent of. If your sister runs a photography studio and she wants you to do her audit, you can't do it. You're not independent. So there's other things that come into play. But you basically pick your clients carefully if you're an auditor. And you don't want to be involved in someone who lacks integrity. That's a big no-no under the ACCT rules. So once you get a client, then you gather the evidence, you do the audit, and then you issue an opinion on the financial statements. So get a client, get the evidence, issue an opinion. That's kind of basic steps. There's other steps in there, but those are basically what we do. Okay, for demand for an audit. What do independent auditors provide the financial statements? Provide to the financial statements? And this is sort of like a CPA question. If there's actually, a lot of times there'll be two that aren't correct, and then there's two that are kind of.
Maybe B.
B is the best answer. A little bit of knowledge possibly in that you have actually looked at it and in that, but credibility is really what we offer to whoever looking at it. Not just knowledge of how the company works and all that kind of stuff, but the actual credibility of the financial statement that they can rely on them. Okay, we have two different kinds of risks. We have business risks and information risks. Business risk. Oops. That was cap lock risk. Okay, so business risk. Business risk is the risk that the client may go bankrupt. It's the risk of being in business, basically. That they won't be successful. Information risk is the risk that an undetected material misstatement will appear on the financial statements. So information is risk that an undetected material misstatement will appear on the financial statements. Okay, yeah, auditors are mostly concerned with which type of risk.
Information risk?
Yeah, we're looking to financial statements to see that they are free of material misstatements. Now, the reason it says undetected is if we do find a misstatement, it's possible that it shows on the financial statements if the client doesn't change it, and then we alter our report. But oh yeah, that you don't detect a material misstatement that shows up on the financial statement. That's the information risk, and that's what we're mostly looking at. Now, we don't want our customers to go bankrupt, but that's usually their job. Ours is to do an audit of the financial statements. If they are going bankrupt, we have to put a note in the audit report. But information risk is really what we're looking at. And that's what we sign, that's what the audit opinion signs on. Not sure. I don't know. Am I spacing? I think I goofed up. Okay, corporate government, board of directors. You guys know this already. The board of directors are those in charge of governing the company. You board of directors. Consist of inside and outside directors. Okay, let me talk about that for just a second. Okay, so board of directors, they're usually there's a group that kind of steer the company. They usually deal with big issues. They don't deal with day-to-day stuff, but big issues. And oftentimes, they will have people who are inside the company. So for instance, the president of the company is oftentimes also on the board of directors. Okay. And by the way, you guys, wait, is this not being recorded?
No, it is.
Okay, good. Oh no. Yeah, it's being recorded. By the way, and just so you know, if you ever do miss a class, something like that, the video will be recorded. I think next Tuesday is election day next Tuesday. I think it is. I don't think we have class.
I'm not sure. I'm gonna need to look it up, but Labor Day is on Monday.
Tuesday, November 5th.
Oh,
Okay, well, we don't have class that day. So, well, more important than class. So, next Tuesday, is that right? No, November 5th, not August. I'm sorry, it's more than a month away. I apologize. Who's running this stupid class anyway? All right. Let's take a look here. Okay, so board direction inside and outside. So inside means that they work inside the company. Outside means that they don't work in the company. They are not part of management. So inside are people that work in the company. Outside directors are those that work outside. Now, the audit committee, these are people that deal with the auditors. And they are a subgroup of the board of directors. So maybe there's, 25 board of directors, there may be 5 people on the audit committee. And these are the ones that deal with the auditors. They're the ones that communicate with the auditors have a problem, they go to the audit committee. The audit committee is made up of, for publicly traded anyways, the audit committee should be made up of only outside directors and at least one accounting expert. This is for publicly traded companies. The small companies may or may not have a board of directors or a accounting committee. So audit committee is only outside directors, and they must have at least one accounting expert. And you might look at that one and say, well, that's kind of odd, but board of directors can have all different kinds of people. They come from all different backgrounds, and you may very well not have, the number of people on the committee that that don't come from accounting. So let's say there's 5 people on here. If you just pick random 5 outside directors, they may not have anyone that actually knows what how you do accounting. So they have to have at least one accounting expert. Okay. And the audit committee is really, again, who the auditors, at least for a publicly traded company, who they're going to talk with. Okay, types of audits. Yeah, we'll go on these. Types of audits. Okay, the first one that we've been talking about is a financial audit. Hey, let me try this again. And this is what we've been talking about. These are for the independent auditors. This is sometimes called an examination. If you hear them talk about an examination, they're talking about a financial audit. And I'm not sure why they use that term, but so a financial audit is the first kind of audit we talk about. Get rid of all these. Second type of auditing is, or audit is the, let's go with the compliance audit. A compliance audit is to see if they are complying one of the set of rules or standards. The most common one you'll see here is IRS audits, tax audits. Are they complying with the tax rules? So an IRS audit is a compliance audit. There's other types of compliance audits. So for instance, like at the school here, if we get a lot of the funding comes from grants. Well, a lot of times they have strings attached. They say, okay, here's some money, but you have to use it for computer hardware. And they may have someone come in and say, okay, well, we gave you this money to buy computer hardware. Let's see the receipts for the hardware. Let's see the hardware itself. Let's see, to see if you're doing it. So that would be, are we complying with the grant? But the most common one that is maybe the IRS. And they're just to see if you complied with their standards. Okay, Operational audit. This is made for future improvements. Similar to like consulting. And you generally are looking, I probably can't fit it on this line. What you're looking for is effectiveness, or efficiency improvements. So effectiveness and efficiency. And then for going into the future, it's, you know, a financial audit, for example, is mostly historical. Right? How much in sales do we have in 2023? How much in you know, cost of goods sold 2023? How much were the selling expenses? Blah blah blah. You get the idea. It's historical, whereas operational audit is how do we make it better going into the future. They're usually much more involved, and they usually have a lot more creativity, you know, and that sort of thing involved in it. And again, they're future oriented. There's a couple more that I'm going to throw in here just for kicks, I guess. They list in the book an integrated audit. And usually that is a financial audit. And internal control audit. Combined. Financial audit is what we've been talking about. Internal control audit is an audit of internal controls that's done on publicly traded companies. And they have to do those together. There's actually a little bit of a quirk to that, which we'll talk about much later in the class. But that's an integrated audit. Sometimes you have also listed as governmental audits. And governments, this is usually federal governments. And they have their own rules. They are not generally accepted rules. They're just their own rules. So government audits are, again, they're very specific, and they're very different than the other ones. Just to kind of give you an idea of what I'm talking about. For instance, well, generally accepted accounting principles. Generally accepted means everybody uses them, right? They're generally accepted. So IBM's going to use them, Microsoft's going to use them, Walmart's going to, everyone's going to use them the same, you know, they're generally accepted. Everybody uses them. The government is different. For instance, there's only one Pentagon. There's only one, you know, Department of Defense. So they have their own rules. They're not generally accepted. The rules are only made for that department, and they have their own rules and their own ways of auditing and what they need and all that kind of stuff. So, and there's no reason for anyone else to follow them because they only apply to, you know, the Department of Defense. So they'll have their own special rules for their own special. And again, it's very different. We're not talking about local governments or state governments. You know, you will have rules that apply to all the local governments. Those will be generally accepted too. There'll be generally accepted governmental accounting rules. There's 50 states. They're gonna follow the same, accounting rules. Illinois is gonna follow the same rules as Iowa is gonna, those are all generally accepted. But governmental, as far as the federal government, they're gonna have their own set of rules because they're so unique. There's only one of them on the planet, so they're not what we call generally accepted. Okay. Happy Bakery wants to, weird showing up my screen. Happy Bakery wants to improve production. Which following audits would be appropriate for this task?
Operational.
Yeah, this would be for the efficiency or effectiveness, be more effective or more efficient, whatever they're doing. It's basic thing. The city of Chicago needs assurance that grant money for homeless residents is being spent properly. Which of the following audits would be appropriate for this task?
Compliance.
Yep. Yeah, are they complying with the grant money? Are you, actually doing it with it what we, what were the strings attached when we gave you the money? Are you actually doing this? Okay. Types of clients. Non-issuers and issuers. This is the terminology that I think we only use in auditing. Non-issuers, these are privately held companies. They're so private, they get an extra P. No, privately held companies. Issuers are public companies. So non-issuers are privately held. They could be companies, they don't have to be companies, they could be just regular businesses that are not incorporated. But non-issuers are privately held. Issuers are public companies. Now, I'll get into this later. Okay, so non-issuers and issuers. And we actually have two different sets of rules for these. Which type of a client is Microsoft?
It's a
Microsoft
public
is
company,
Oh,
publicly traded
Issuer.
company.
Yeah, so they're going to be what they call an issuer. And again, this is the terminology. I didn't come up. I don't know if anyone else uses this terminology or not. But we do an auditing. Be an issuer. Okay, sole proprietor,
non-issuer.
non-issuer. The sole proprietor will not have any shareholders. They will not be publicly traded. They may not even be a corporation. Sole proprietor just hang a sign out. Okay. American Institute of Certified Public Accountants, AICPA. Now, the AICPA, when you pass the CPA exam, they will send you an invitation. Do you want to join the AICPA? The AICPA is just a club. It's a club that, all the members are CPAs. So you get your CPA license and they'll send you a thing saying, hey, do you want to join us? Yeah, okay, send us a $300 check. But they're a club of CPAs. Now, that's all they are, though. It's not a government agency. So the AICPA does not have any direct authority over anyone. They're like the Boy Scouts or Girl Scouts or whatever. So when they issue something, not given any other information, that if they say something, you can just ignore it because it's just a club. It's like saying, well, the Boy Scouts think that you should do, Now, They get their power though from other organizations that use their literature and their materials and all that kind of stuff. They actually are the ones that write the audit report. The audit report that they write, every state looks at it and says, okay, everybody, you have to use this audit report that the AICPA made. So you must use this AICPA audit report. And it's illegal to use that audit report if you're not a CPA. So, you know, you have this thing that the AICPA doesn't have any power of its own. You know, they can't do anything about it. Well, I guess they could sue you for copyrights. They have it. Done it, suing for copyrights. But for the most part, you know, they don't have any power. However, because these other organizations, states tell people, look, you have to use their rules, that's where their power comes from. Okay. So AICPA, it's a club of CPAs. Okay, and for the most part, you know, that's what you are. When you join them, you're just a member of their club. Now, what do? They do a number of different things, but the big things are they make the accounting rules. And that's called GAAP, Generally Accepted Accounting Principles. Oops, that's not GAAP. That's the store GAAP. Okay, so they make the accounting rules. The second thing that they do, hey, how come that's the second thing that they do is they make the auditing rules. I think standards is what they would prefer that I call that. And that's called GAS. Generally Accepted Auditing Standards. I should write that out. So they make GAS, they make GAAP, Generally Accepted Accounting Principles. They make GAS, Generally Accepted Auditing Standards. And one of the other things that they do is they make the CPA exam. So here's this club of CPAs. And they make the accounting rules, they make the auditing standards, and they make the CPA exam. Now, here's the thing. Usually, oftentimes, these all become state laws. So because they become state laws, everybody must follow those rules often. And the CPA exam, if you're wondering about that one, every state says, by the way, if you want to become a CPA in our state, you got to go take this test that's given by this club of CPAs. They make this test, and you got to take their test as part of our licensing. So every single state does this. They could wake up tomorrow and say, no, we're going to make our own test, but none of them ever have, and I doubt they ever will. But it could be, you know, Illinois could say, no, we're going to make our own CPA exam for our licensing, but no one has done that, and they won't. So the AICPA makes a test, everybody uses it, is these for state, but again, this is a club. They have no influence over, they're not a government agency. They can't actually do anything about, say, licensing CPAs. They can make the test, but they don't actually issue the license. The state issues the license. Okay. So who needs to follow their rules? Generally, issuers, publicly traded companies, must follow. Oops. And non-issuers often must follow those rules too, because they are state laws. It's a little bit more, it's a little bit more strict for the issuers, and I'll tell you why. The issuers are governed by the Securities and Exchange Commission. And the Securities and Exchange Commission says, by the way, you have to follow these rules by this club, the ACCT. So even if it's not a state law, you still have to follow the rules by this club, because they say, you say, well, I'm in Illinois. In Illinois, they didn't adopt that as a state law. If you're publicly traded, the SEC says, well, you have to follow it anyways, because we just told you did. They're pretty rude about that. So anyway, generally you have both these groups that must follow the CPA, the ACCT. Non-issuers must follow whatever state laws. The difference here being, though, is the accounting rules. Generally speaking, you can use whatever accounting rules you want if you're a non-issuer. The gap is usually only for issuers. It's only required for issuers. So the accounting rules are usually only for issuers. They are required to do it. Non-issuers have a little bit more leeway. And you can have non-issuers that are a cash basis. You can have them that are IRS basis. They use the IRS code. They'll if you go in to do their their audits, they'll literally give you the financial state, based on their taxes. Okay. Auditing Standards Board, you can guess what that is. Make the auditing standards. I don't know why I'm writing this a second time. No, the Auditing Standards Board, you can guess what that is. That's auditing standards. They make the auditing standards. Certified Public Accounting Exam. Used by every state. Licensed CPAs. Okay, now you might be wondering, well, who actually issues CPA licenses? The State Board of Accountancy. So there's an Illinois Board of Accountancy. And they issue CPA licenses in their state, for the state. Now, a CPA license is the same as an auto license. I think it's the same thing as a driver's license. The CPA license allows you to do work as a CPA. Just like a driver's license allows you to drive a car, it's exactly the same thing. It's a license. They give you a test, the AICPA test. Here's your test. They have a work requirement, 1 to 2 years, depending on what you're into. And when you're done with that, they say, okay, that's kind of like the driver's test. So you pass the written test, the CPA exam. Then you take the driver's test, which is actually working for a couple of years. And they say, oh, here's a stamp of approval, here's your license, now you are licensed to do CPA work. And it's the same thing as a driver's license. Like a driver's license, the only one that can revoke that is the state. So, the AICPA cannot revoke your license. The federal government cannot revoke your license. Only a state can revoke your license. And the rules that you follow are you follow the state rules for your license. So states issue the license, states can revoke them. They can give you penalties and stuff like that. They can, depending on what's appropriate as far as their professional standards are concerned. They're the ones that regulate it, basically, in their state. So the CPA, the licensing of the CPAs and basically the legal aspects of it are all done by the states. Federal government can't do anything about it. Okay. Securities and Exchange Commission, issuers. Must follow. What time is it?
7:45.
We'll cut off at like 8. What should we have left here? I don't even know. We'll finish up this page and then we'll call it a night. Issuers must follow SEC rules. So if you're a publicly traded company, so this is for publicly traded companies, and if you think about the federal government only regulates things between states. Now, if you're publicly traded, your stock is available to anyone in any state if it's listed on the stock exchange. So if you're a publicly traded company, the SEC has absolute rule over, you have to follow their rules absolutely. So whatever the SEC says, IBM has to follow their rules. Non-issuers. You don't have to follow any SEC rules. If you are a non-issuer, notice that you are not your stock is not being traded between people in different states and all that kind of stuff. Non-issuers, they do not have to follow any SEC rules. There is something kind of funny about that. That if you're IBM, billions of dollar company, and the SEC says something, you have to do it. But Joe's hot dog stand, SEC, they don't have to follow anything SEC says. They just ignore it. But it's basically because it's within the state. So non-issuers, they are. It's not available to. You can have it. You could have a corporation that has shareholders in different states, but if it's not publicly traded, if it's not something that can be done, anonymously over the different clearinghouses and all that, then they have no jurisdiction over it. So privately held, they don't have to do anything. They can ignore the SEC. If you're a publicly traded company, you have to follow all the rules. Okay, so Security Exchange Commission, and these are the ones that they will make the make all of the rules for publicly traded companies, even beyond what I should use the terminology. Okay, so they make all the rules for public trade companies. And by the way, the same thing goes true down here, Public Company Accounting Oversight Board. This is a subset of the SEC. And they are mostly involved with it, but the same thing applies to them. The issuers must follow, non-issuers. You don't have to. I just cut and pasted that. I'm teaching you guys how to be lazy like me. So it's a subset of the SEC. So this is underneath the SEC, and they are more in tune to governing the accounting and the auditing of governing and accounting for publicly traded. So they're part of the SEC. And they only look at the auditing and the accounting areas. So for instance, if there's something like with market manipulation or something like that, they don't deal with that. That's SEC governing. Some of the more detailed list of reporting and stuff like that, they do that. But as far as the accounting and the auditing, basically reporting, maybe that's a better way to put it. Ooh, I just heard thunder. You guys hear thunder? I mean, not through my lousy microphone, but you know. All right. So subset of the SEC. So it's very narrow that they're only looking at basically the accounting and the auditing aspects of publicly traded companies. But issuers must follow the rules. I should say, this is the PCAOB rules, I should say. And yeah, that just rolls right off the tongue. You know, they just made this, so it's but you know what this actually came from? The Sarbanes-Oxley. You guys probably heard of that. Sarbanes-Oxley is a set of rules that came from the Enron fraud case. Enron, very famous fraud case, billion-dollar fraud case. Before Enron, a big fraud would be 40 million, $50 million, something like that. They weren't big. And then Enron came and we're talking about billions of dollars, billions, you know, with a B. It was crazy. Everyone went into a panic. It started to settle down. And then right after that, WorldCom was another big fraud, billions of dollars, and the entire market panicked. The Sarbanes-Oxley Act had been around for something like 10 years. And every time they tried to get it approved, obviously every company, you know, they all politically, they got it crushed, you know, in Congress that the Sarbanes-Oxley rule was never going to see the light of day. Well, everyone in the market started saying, well, we can't trust the financial statements anymore. The stock market started to crash simply because no one trusted the financial statements. That credibility that auditors gave was no longer there. So companies were desperate to find something to reassure the markets. And then, so here's the Sarbanes-Oxley rule that they've been killing for the last 10 years. They said, oh, by the way, let's have that with it. So the Sarbanes-Oxley rule came out, and that's how it got approved. It was actually the companies asked, they begged for it after, you know, because it was literally like no one trusted the markets at all. And Sarbanes-Oxley came in and it restored trust in the markets, and they did exactly what they had hoped it would do. But the Sarbanes-Oxley Act created the PCAOB, and I wish they used some better acronym, but, oh, you can't, it's telling me. Okay. All right, so, which of the following organizations can license CPA firms, public accountants? You guys are sleeping, aren't you?
It's A.
A,
Nope.
American Institute, yes, A.
Nope. B, states.
Oh, the state,
Oh.
Only the states.
yes, we are sleeping, obviously.
Well, thanks for being honest about it. Which organization can revoke a CPA license?
The states can do that also?
Yep, only the states. No one else can do it. AICPA is just a club. Securities and Exchange Commission has no jurisdiction over licensing. They do register CPA firms, which is different, but they register the firm itself, not the individual CPAs. So yeah, states give the license, states can take them away. That's the main. All right, let's stop here. And we'll pick this up next week. CPA firms, this is kind of an important one. I want to. Which one more is left here? Not too much. So what we'll do is we'll finish this up. Oh, there is a little bit more than I thought. All right, yeah. So we'll finish this up in the next week. And so we'll finish this up, and I'm going to change. I'll do it right now while we're all in the room. Oh, I was already there. Let me change this. This will be. Oh, there it is again. We're getting thunder here. What's a week from 9/6? That'll be 9/13. Due date. So we'll back that up a week. Okay, so we'll finish up the chapter 1 and 2 handout next week. I will. Message here. I will definitely look into the book thing. Tomorrow morning, I'll go in. I got a day class in there, so I'll go in the morning and figure it out with the bookstore. Yeah, so hopefully that'll be figured out. And I did get the. If you did already spend money on the books, if you didn't get it from Roosevelt, see if you can return it to Amazon or wherever you got it. But if you did it at Roosevelt, give it to me and I'll take it in there and see if we can get that account credited, and then get it put on the Laker bundle. Any questions? And I'll have your answer tomorrow. It should be a positive answer, because whatever book they tell me that I need to put on there, that's what we'll put on there. Any questions?
Actually, I do have a question. So I don't know if this is correct, but you said that we're not going to be using any access codes. It's going to be a physical book, or is it the other way around?
You don't. The only code you need is for the ebook. And a lot of times they'll have an access code,
Okay.
the ebook, but also for turning in the materials. We don't need the access code for turning in the materials. It would just be for the ebook.
Okay, just for the ebook. Got it.
But I'll be honest. Whatever they tell me that we were going to do for the Laker bundle, that's the one we're getting. Because I mean, it's so much of a better deal than anything else. So we'll go with that. And I'll let you guys know tomorrow.
Okay, thank you so much.
I apologize for it. I had no idea that there was any problem with any of it. So, okay. Any questions? Don't turn anything in yet. When we finish up next week, we'll go through and turn the handout and whatever else we do into Blackboard. But you don't need to turn anything in tonight. Any questions? All right, well.
Yeah, I was just gonna say, I'll not be able to attend this class on September 17th.
Okay.
I'll be out of country for a week, so
Okay, and that's fine. It'll be recorded. I usually get the recording usually goes up the same night. Occasionally,
If I get the network, I'll be able to attend the class, but if I do not get the network, then I'll not be able to join it.
it'll be recorded.
Okay.
Yep.
Okay, thank you.
Yeah, and
And I sent you the email during the break.
I saw that. Yep. And I will take that with me.
Thank you.
Yeah, no, thank you, because I apologize. Any other? Okay, well, and this will be posted, up. I usually try to get it up the same day. Usually by midnight it'll get up. Sometimes it depends on, the only time there'd be a problem is sometimes going, loading up. I put it into YouTube, because YouTube has a really good closed captioning thing. And you can put on the closed captioning, you can, listen to music and have the closed captioning and jump around and, fill it and look at stuff. So anyway, yeah, so it'll be on YouTube, well, hopefully by later on tonight, but almost always I get them in the same day. But I think I say in the thing that within 24 hours, but usually the same day. So if you do miss a class, I mean, as whatever, something comes up, whatever, you don't even need to tell me. It'll just be, but just know that you can always get the information. And the handouts are online, so you can also go to the online if you didn't get the email or whatever. Okay,
Professor, I have emailed you the payment what I have paid for the class access code. I
one more
have
time.
emailed you the screenshot from the
Uh,
RU bookstore. I have emailed you.
yeah, and I'll take it with me in there and see what they say. I would think that they'd be able to reverse it out.
Okay.
I mean, they haven't sent anything yet, so.
Thank you so much.
Well, yeah, like, I'll let them know that, it was my fault or whatever, because, yeah, you shouldn't have to pay anything. The Laker bundle is there for a reason, so that's what we're gonna be using. Okay, and I apologize for that. I had no idea that they had kind of like changed the rules on it. But we'll figure it out. Okay, any other questions? Go enjoy the thunderstorm, and I'll see you guys in a week.
Thank you. Good night.
Good night.
Have a good night.
I will, you too.
Good night, Professor. Thank you.
Good night, thanks.
See if you're still alive. 3. When you ride roller coasters, your organs move.